What's up, guys? Jay Martin here, investor and CEO of Cambridge House. My guest today is Peter Boockvar, the Chief Investment Advisor at Bleakley Advisory Group. Today we get into the inflation narratives and how investors should hedge their bets accordingly, how to construct an ideal portfolio to make sure you don't get caught in any kind of a trap. I learned a lot. I hope you do too. 3 things before you enjoy this interview. Number 1, if you want to subscribe to my weekly newsletter, there's a pinned comment right beneath this video where you can do so. I publish every Friday. I talk about what I'm doing in the market and my key takeaways from conversations just like this and many others. Number 2, the ad revenue from this channel is now donated to an organization called Zero Ceiling. Zero Ceiling's super close to my heart. Their mission is to end youth homelessness. The way they do this is by giving at-risk urban youth the opportunity to relocate to beautiful wilderness environments, support them with housing and career training, and just generally great influences on their life. And number 3, if you prefer to listen to my content as opposed to watch it, you can find me wherever you listen to your podcast. Just search for The Jay Martin Show. All right, here's Peter Boockvar. Enjoy. I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today. Please give my panel a round of applause. Welcome. What's up, guys? Jay Martin here, investor and CEO of Cambridge House, and my guest today is Peter Boockvar, the Chief Investment Officer at Bleakley Advisory Group and the editor of the Boock Report. Peter, it's good to see you.
Thanks, Jay. Appreciate having me on.
Yeah, well, thanks so much for making the time. I'm excited to jump into a web of directions with you today, but for anybody who's not familiar with you and how you spend your time, could you give us that highlight reel, Peter? What is it that you do?
So through Bleakley, as CIO, I manage 2 investment strategies. One's a global macro, one's an income-focused one, in addition to helping all of advisors here construct portfolios and also running the investment committee and helping to make those decisions. And then with the Boock Report, I'm writing daily on the important macroeconomic and market things that are relevant. And I write just a few quick snippets a day, not enough, hopefully, to bore people, but quick enough to be succinct and let the reader move on to other things, but still getting a good feel for what's important and what's not, what's going on out there. And
yeah,
also throwing in my 2 cents all the time.
Yeah. And it's a good hack because I've seen like 2 or 3 a day, right? And they're kind of like, if you don't have time to be on the Wall Street Journal all day, right? It's a nice highlight reel of what's occurred through the course of the day. Yeah. And you made a point, what's important, not urgent. I can't recall exactly the words that you said just now, but I recently I caught you on stage at the New Orleans Investment Conference a month or so ago, and I really appreciated your moderate standpoint on some items that were brought up in discussion, like the Evergrande crisis, right? Like, is this going to be the big one or is it nothing at all? And you're like, well, it could be neither, one or the other, a little bit of both. Like it's not always this or that, right? Things aren't binary like that. So in the macro environment right now, what is catching your attention, Peter, as significant that impacts investors and their future?
The most important thing right now, and I think it'll last for the next couple of years, is this inflation story. And it matters for many different reasons. It matters for just the average family that's trying to make ends meet, and wages are not going up faster than inflation, or at best to the same rate where they're just moving in place or running in place. It matters for businesses that are having to deal with higher input costs from an employer standpoint, having to deal with higher labor costs and whether they can absorb that through higher productivity or they need to pass those prices on to consumers. And for what it means for markets, what it means for the Fed and other central banks, what's their response function going to be to this higher inflationary world? Because we're in a world of, as we know, negative rates, 0 rates, massive QE, expansions of central bank balance sheets. And that was okay, I guess, when inflation's 1 to 2%. But when you enter a higher inflation regime, that's a difficult policy to get away with for a period of time. And also, we know that there's this incestual relationship between central bank policy and markets, and that if the inflation story forces the hands of central banks to tighten policy, which we'll get to, and we seem to be on the cusp of, that will then impact markets, which will then have a direct impact on the economy. So it all comes down to this, and we know inflation's here. It's not a debate anymore. It's just a question of how long it persists, and even when it settles down, to what level does it settle down to? Does it just go back to a pre-COVID level, or are we going to see a higher sort of base level for a period of time?
Right. And if you were to speculate, which direction does that go?
I'm in the more persistent, sustainable inflation camp that I think by February 2022, on a rate of change basis, we'll probably see the peak, maybe in the US, at least 7%. And thereafter, on a rate of change basis, things will slow. But I don't think we're going back to 1% to 2% inflation for not until at least 2023, 24, likely more 2024. And that we're going to more settle out at a 3% to 4% inflation rate, which creates its own problems again, because the world is on a foundation of 1% to 2% inflation, particularly global debt levels that we have and the level of interest rates that we have. And that 3% to 4% is literally a game changer.
And so when you talk about that forecast, Peter, and your expectations moving into February of 2022 through to 2024, right? Do you factor in, or how much, I guess the better question, do you factor in, Jerome Powell saying they're going to start tightening the taper to the tune of something like $30 billion a month, halting it completely by around March of 2022? Do you factor that in to your forecast and thought process, or is this talking about that?
No, I do. I think QE doesn't really have much relevance to actual consumer prices. It's really been more relevant to asset prices and monetizing the U.S. government debt. So by ending QE, it's not going to really move the needle on my inflation forecast. Now, if it tanks the markets, and by tanking the market, you hurt the economy, well, then, yeah, indirectly, it will have that effect. And it certainly could. I mean, the markets usually have corrections around the end of QE. It's really not until the Fed starts changing its Fed funds rate that it can directly impact the demand side of the economy and therefore deal with inflation. I'm of the opinion that this is still an extremely dovish committee, and that Powell is one of the biggest doves there is. And Brainerd, now his sort of partner in that dovishness, is his number two. And the open spots on the committee will likely be filled by doves. And that I think the market's expectations of rate hikes 2 to 3 next year following the taper, I think is aggressive, because you can assume that, again, the Fed is always quick to ease and they're always very, very slow to tighten. And if by beginning the tightening, we start to see some market accidents, you can be sure that the Fed backs off from that.
Right. Because who wants to be the Fed chair that's holding the bag, right, and actually crashes the market? Like no one's gonna volunteer that position, right? So I'm on the same page as you. If we begin to tighten and the market's correct more than, I don't know, people want them to or whatever, right, to the point of decreased public opinion or whatever, like who's not going to take their foot off the gas pedal there, right? Can you imagine that occurring? I can't. Well,
you're right. It's going to be tough for them to do that. The difference this time around, though, is this inflation story. When inflation is low, I like to say, the central banks can have a hall pass to go anywhere they want and do anything they want and experiment with any policy they want. And if markets start to buckle, well, they can easily back off because inflation is low. But now that inflation is not low, it's in fact high. Well, what do they do if the S&P is down 20% and we're still seeing sticky inflation prints? That, I think, is a fork in the road that we're headed for. And if I were to guess, Powell will be more inclined to save the S&P 500 rather than get aggressive with trying to control inflation. But that is going to be a choice that he's going to have to make, I believe, at some point in 2022.
And when somebody comes to you, Peter, and says, look, like these inflation numbers are so influenced by the supply chain disruptions that we're experiencing, and now, with Omicron, again, whatever, this is probably going to occur continuously for another 24 months at least, right? Like little variants popping up, travel restrictions here, maybe borders closed over there, random countries around the world, coupled with maybe more natural disasters than there used to be. I'm in the Pacific Northwest, just outside of Vancouver, Canada. 3 weeks ago, we were cut off from the rest of the country after some significant flooding, cutting off our Highway 1, Coquihalla, and the rail system from the rest of Canada. And we're seeing this, every fire season seems to be worse. Every flood system seems to be worse. How much do you factor in those environmental or, pandemic-related supply chain disruptions as an influence to these inflation numbers? How much do you dismiss them?
Well, I don't like to dismiss them, but I just think it's really hard to quantify and try to forecast. That's really hard to do. I think, but it's even hard to forecast that, for example, this year, Vietnam deciding to shut down its factories for a month because they had a zero tolerance COVID policy, and that Nike sourced half their goods in factories there. That was tough to forecast too. That sort of draconian response to COVID. So I think it does make it more difficult in trying to figure out the supply side. But we've also had, a massive increase on the demand side too, that coincided with these supply problems. I mean, inflation blips can be supply side driven or demand side driven, but that's typically not sustainable. More sustainable, persistent inflation is when both of them come together. And at least in the US, when the US government spends $5 trillion within a year and basically giving money out to people, that created a level of demand that the supply side was just unprepared for. And even, you look at housing, and this is where I'm going to point the finger at the Fed. Well, not only did the Fed help to finance the $5 trillion, but I would argue that house prices in the US, and we know in Canada, house prices are up aggressively, in Australia, New Zealand, even in parts of Europe, that home prices and home price inflation, you can call it, wouldn't be as aggressive if rates weren't so low. And that home prices in the US would not be up 20% a year if mortgage rates were in the 4% range instead of the 3% range. So there's a lot of finger pointing that can go around here, but a lot of it is at both monetary and fiscal policy. But of course, COVID certainly threw mud in the gears of things and probably exaggerated things. But there's enough policy blame to go around for better or for worse.
Okay, so if I'm following your 3 to 5 year forecast here, looking at these inflation numbers, what I feel like I should do, Peter, is borrow as much money as possible at these rates, buy some more real estate, build my war chest in gold, silver, maybe Bitcoin, and hold as many assets as possible. What do you think about that strategy? Like, what's the trade, I guess, is the question, right? Like, what are you doing personally, recommending your clients doing? If that's my game plan, what are my blind spots? Where could this screw me? What do you think?
Well, at least in I'll talk broadly. You talk about real estate. It depends on with respect to real estate. I own some REITs, and I own my house and some other real estate. But you need to be in real estate where you have pricing power, where leases sort of roll over quickly. Where if there's inflationary pressures, you can adjust your lease. If you're in a 20-year, a 10-year office lease, and things are fixed, well, you may not have as much flexibility, and it's not necessarily as much of an inflation hedge. Yeah, you'll get rent escalations, as opposed to an apartment where your tenant is probably gone after a year or two, and you can quickly adjust the rent or else. So it depends on the real estate. Now, if you're looking for just a place to park money from a wealth preservation standpoint, yeah, you can buy a piece of land, for example. But on the other hand, real estate prices are very expensive right now. We know capitalization rates have gone down a lot, and it's hard to find certainly bargains in real estate. Now, gold and silver, on the other hand, as 5,000-year coins that have stood the test of time, so to speak, those have dramatically underperformed as inflation hedges, and in fact, sort of failed people from that perspective. But I don't necessarily think that's reason to give up. I still think that there's still a bull market ahead of us with gold and silver, and I remain particularly bullish on both of them. I think people are under this false assumption that the Fed is somehow going to get ahead of this inflation curve, and other central banks will as well. And I just think that is misplaced. I think these central banks are going to be very slow in responding to these inflationary pressures, with all having their fingers crossed that it's just these supply side challenges will resolve themselves. And yeah, it'll resolve itself at some point. I just don't think it'll be as quickly as they hope it will. Now, from a portfolio standpoint, my global macro strategy, about a third of it is in inflation type securities, whether it's oil and gas stocks or fertilizer, gold and silver, as I mentioned, or owning some tips, and even having some cash as optionality and dry powder, and some value stocks that already have low expectations embedded in them via a low multiple, and being more sensitive to valuations and being more careful with the high multiple stocks that could be vulnerable to monetary tightening and high inflation.
Got it. Okay. Now, could you look at what's going on in Turkey right now do you look at what's going on in Turkey right now as a bit of a preview, ominous potential future for what could occur in larger currencies, the euro, the dollar, the yen, et cetera? I know the approach there is a bit different, like keeping rates, I think, near zero, right? That's the game plan. It's a funny game plan, but that seems to be the game plan. What do you think about that?
Yeah, so I guess what you're saying is that negative real rates in Turkey has resulted in a currency crisis there. And can we see negative real rates in other countries cause sort of currency crisis as well?
Yeah, and as I understand it, like the playbook would be to increase rates, right? Decrease borrowing, all of this stuff. But that's the opposite approach in Turkey. I think for ideological reasons, they're keeping rates extraordinarily low, and that may be exacerbating the problem. I'm not sure, but what do you think?
Well, Turkey is certainly a unique case because of the economic ignorance of the president and his basic takeover of the central bank. A lot of it, when it comes down to a currency, is confidence in that currency. It's confidence in and trust in one central bank, and the trust that inflation and sound money is respected. And people don't have that trust at all with the central bank of Turkey because of the influence of the president. So when do other central banks' sort of trust and faith get questioned? And I think we're headed in that direction. But I think we may not know until next year, when we see to what extent they respond to these inflation pressures. You can be sure that real rates will remain negative in many parts of the world for a while. Interestingly enough, emerging markets who have a lot of experience outside of Turkey that have experience with inflation, they're trying to get ahead of the inflation curve, like the Bank of Russia and even South Korea, which is technically developed, and Brazil and Mexico, that are raising interest rates because they don't believe in negative real rates, because they don't have good experiences with them.
Right. Okay. And it kind of answers the question, because, I was wondering, is the lira like the first of a handful of dominoes to fall, right? Or is it an anomaly because of their fiscal policy, right? And that maybe it's more of an isolated event because, to your point, economic ignorance, whatever you want to call it, on behalf of the president, but their approach is different than you would normally see.
It is, but I think in the U.S. we have real rates that are more deeply negative than they do in Turkey. We're pretty much the same. So I think inflation in Turkey is running about 20%. I think their last rate cut took their overnight rate down to 15. So they have a minus 5% real rate, negative real rate. But we do here. We printed in the US, we printed 6.2% headline CPI, and the Fed has rates at 0. So now, obviously, we're quite different than they are, Turkey, but there is a similar mentality to where rates should be relative to the pace of inflation.
Okay. Now, do you watch the cryptocurrency market at all, Peter? How much attention do you pay to the crypto market?
To the currency markets?
Cryptocurrency markets.
Oh, crypto. I'm sorry.
Yeah.
I watch crypto every day because, looking at strictly the prices of crypto. So putting aside, the DeFi trend and NFTs and the whole build out of the crypto world, because I try to separate the price of Bitcoin or Ethereum from these, from this infrastructure that's building off these blockchains. Because I feel like, and I've said this in other interviews, that a bull in Bitcoin is a soulmate of a bull on gold, right? Because they both are skeptical of central banks. They both want to be something that is limited in supply, that can't just be printed away, and that is a store of value. And both right now are sort of serving that purpose. Now, whether Bitcoin is just proven to be a risk asset on and off, we don't know yet. It just doesn't have that much history. I mean, the history of crypto from a price of coin perspective is all they know is essentially 13 years of global money printing to an extraordinary extent. That's all they know.
Yeah.
Gold being 5,000 years old, you've been through a lot of things, both ups and downs. You've been through world wars. You've been through hyperinflation. You've been through deflation. You've been through monetary debasement. You've been through a lot of different things with multitudes of generations. So that at least has a track record. But yeah, there's no question that I watch it both from a risk appetite measurement perspective, and to see, is Bitcoin going to be an anti-dollar? Is it going to be an inflation hedge or not? Well, and I think that still remains to be seen. But again, at least I know it was created for the same bull case that people have for gold and silver.
Yeah, philosophically, it fits the mold, right? And I'm similar. I invest in and I hold a lot of gold and silver, and I hold a lot of Bitcoin and Ethereum, and I don't play in the altcoins too much because I don't feel like I have a competitive advantage there. Whereas I might in the spec markets, I just spend more time there. I'm still unclear on what I own in the Bitcoin world because of a 13-year track record, exactly what you just said. And because I don't know how I would define it, my selling strategy it's very muddy to me, because am I buying a future currency? Am I buying a bet against the US dollar? Is this a safe haven asset? Is this just a speculation? I don't know yet. I want a horse in the race. Absolutely. And so I dollar cost average in, because that to me is like the way I can sleep at night, build a position and not feel too stressed about it. Right. But also feel like I'm participating in the upside that I want. And so for you, is that similar? You said it might end up being a bet against the dollar. It might end up being an inflation hedge, but we really don't know yet because 13 years isn't enough to really prove anything.
Yeah, exactly. I mean, I think we need to sort of hit a rough patch in the markets to sort of test it. Now, we did with COVID for sure in March 2020, but Bitcoin sold off with the market. So I don't know what it really was, but hey, gold and silver sold off too. So it remains to be seen, but it's here to stay. And you have to pay attention. At the same time, I'm trying to learn as much as I can about where the future goes with the further build out of DeFi and how disruptive it's going to be to the financial system. Yeah. Okay. Now, Peter, could I ask you to define modern monetary theory for me? As best as you understand it. I know this is like a sort of conceptual idea that we're just beginning to get a taste of, and has it arrived? Is it whatever? But how do you talk to me about your thoughts on MMT if you want to? Yeah, it's here. I mean, to me, it's just simply the government just printing money and the government spending it in order to try to generate economic growth. To me, that's it. It's a reliance on government spending to drive GDP, as opposed to being more reliant on the private sector to do that job. And their theory is, okay, well, if inflation is a result, we'll just raise taxes and that'll slow growth and quell inflation. I'm not sure that is really that smart of thing to do, but that essentially is what it is in so many words.
Okay. And now following on that thread, what if any was your interpretation of the quote the World Economic Forum came out with last year that said, and it was largely taken out of context and all sorts of internet memes, but you will own nothing and be happy by 2030. You will own nothing and be happy, in relation to adoption of modern monetary theory. How do you process that, or is that even on your radar?
It's not on my radar.
Okay.
I think what we're seeing right now is that the inflation we're experiencing is causing people to question MMT. And all you have to do is look at the debate going on in Washington about the Build Back Better plan, where obviously the Democrats want to spend $1.75 trillion, and the pushback is, and their defense of it is, well, over time it's investments and it'll end up being an inflation mitigator. And on the other hand, the other side saying, well, this is just going to further exacerbate the inflation story we have. So now, if inflation was low and rates were low and the Fed was not raising rates, then I think there would be sort of more license to do this as MMT. But I think the inflation story now has caused people to question whether this is effective or not. And again, I'm not a believer. I think it's relying on the government to create sustainable economic growth. If history is any guide, that's typically not the best bet.
Right. Okay. Awesome. All right. Look, Peter, appreciate your time. Thanks for coming back on the show and chatting with me. Let me hit you with questions, getting back in front of my audience. At Boockvar on Twitter. And you're super active on Twitter, so I encourage people to follow you. But thanks so much. I appreciate it.
Thanks, Jay. Always fun.
Okay, guys, 3 last things. First, if you enjoy my interviews and would like a bit more, you can subscribe to my Friday newsletter. It's free, and the comment to subscribe is right beneath this video in that pinned comment. In this newsletter, I share my key lessons learned, takeaways, and any actions that I might be taking in the market as a consequence of what I've learned on the show. Second, when I started a YouTube channel, I never anticipated generating any advertising revenue. But coincidentally, I do now, which is awesome. And so what I've decided to do is donate this to an organization that is very close to my heart called Zero Ceiling. Their mission is to end youth homelessness. The way they do this is by providing young people experiencing homelessness with supportive housing, employment, professional support, life skills, and outdoor adventure. Because often young people in urban centers with no resources will never get the opportunity to experience wild places, nature that can be so transformational, and absolutely was for me. Third, if you prefer to listen to my content, you can now find us wherever you listen to podcasts. Just search for The Jay Martin Show.